All right, check, check, radio check. I would like to thank everybody for taking time out of your busy days and schedules, and I hope everything's well. It is 4:30 Apple time, so if somebody wouldn't mind typing into chat that you can hear me, you can see me, and that technology is not an issue. All right, so we got that. Good, thank you. All right. I just got back from Texas. Crazy day yesterday, up at 2:30 in the morning, get on my flight or get on in my truck to go board a plane at 4:20. I look down and flight's been delayed. It's 7:20 means I missed my meeting at noon and had to reschedule that meeting for that evening and ended up overstaying into Texas, San Antonio, as a matter of fact, and then flew back today, landed at 12 o'clock, had a 2 o'clock, and I have my wealth today. So if I'm going a little fast or maybe it's not as clear as normally I would be, I ask for your pardon because again, I've been juggling. But I bring that up because while we were in Texas, we were helping one of our advisors that has now onboarded to the Simplicity Wealth Advisory Forum, and they were going through, to their clients, exactly some of the features, benefits, and technologies and support that Simplicity is offering. Now, again, we are now Simplicity Wealth Advisors of Princeton, formerly Professional Planning Services. We're very blessed, and so we've been conveying a message since we onboarded and started our onboarding last August. But as Simplicity continues to expand and roll out their technology, I'm excited. So this may not be in a complete linear fashion from an explanation standpoint. Like if you were meeting me for the first time, I might go a little bit more in depth. But what I wanted to do, and over a series of topics, I wanted to sort of just do a little bit deeper dive on some of the strategies or communications or thought processes that we are invoking with our clients, with the help and support of Simplicity and Simplicity Group. It really is exciting times for us. I just want to give you that as a precursor. So the reason I wanted to talk about direct indexing this week, and then next week we'll talk about tax loss harvesting, because they do go hand in hand, lock and step. So with that, before I get into direct indexing, I do think it's important that we say, hey, what's our approach? Right. So our foundation is we believe there's six fundamental financial planning considerations for all folks, right? Just on a high level, maybe some of these might apply to you where you're thinking, hey, we have longevity in our family. And you know what? I hate taxes. So we might come up with a strategy that is different and unique for you. But ultimately, what we're framing this is we want to start from a smart perspective, really dial in to your household's relevant risk management. And I think that that is something over my career. One of the things I've discovered is quite often, the industry standards on assessing risk are very broad, and it's almost, and I'm guilty of this in the past as well, CYA, right? But as I've come to work closely with clients and households, one of the things I've learned and discovered over time is that quite often there's say in a dual household, one spouse might feel one way and another spouse another. So really dialing in and making sure that we're thinking about your beliefs and your feelings and your tendencies as it relates to risk and forecasting are unique to you. And then we're going to apply discipline, right? And that's what we're going to talk about today with direct indexing. And then, lastly is communicating that progress. And that's where I think we start to shine is embracing in the technology that we've, started to roll out there, which is asset lock and the ability to have somebody watching all your accounts 24 hours a day, 7 days a week, 365 days a year, and you're alerted if a predetermined pain level is reached. It just, to me, it just makes sense. Sitting in an audience where, everybody just raised their hand and says, yeah, I want that. We thought that should be standard in the industry, and nothing could be further from the truth. It's almost impossible for any single advisory or planning firm or even the big boys to individually for their clients without the use of technology, which we have a proprietary approach, and we'll get into that. But as of today, really, I just wanted to refresh that these six, planning consideration, right? So we have longevity. This again, it's really, really one of the areas that we stress because, you know, we're all here until we're not. But when the other person is still around, or even if you're both here, but one of the people in our household or loved ones can't be cared for, right? Who's doing that lifting, that transferring, that bathing, the medication? It really is a drain, and it's for better or for worse, when we get married in sickness and in health, right? Maybe we weren't thinking about all those things when we were 20 or 30, but now it's with Americans and people living longer with medical advancement, health aging, we're starting to see more and more of the, Parkinson's, Alzheimer's, or congenital deterioration, right? So liquidity, right? Things break, inflation. We know things are can become more expensive. Markets. The one thing about markets is the difference is once you transition. I was just on with a client today. That was the appointment at 2 o'clock. And that's why dialing in on that income. But if you're pulling income and you haven't really thought about it or planned for it, and you're pulling income from an account when the markets are down, right, that can be really problematic and have a real severity on the long-term care or health of your finances. Mortality, the takeaway here is that if one of us passes, it's almost a certainty that the household income will go down, and have we planned for that? And then it's taxes, right? Taxes, I don't have a problem paying my fair share of taxes, but when I see the waste and abuse of the supposed stewards of our funds, right? And then the solution is, well, let's raise it. I'm cognizant, and I'm a big proponent of creating and designing plans that allow us to transfer taxes or assets tax free. Again, one of the things that's just all over all the time is Roth conversions. But Roth conversions, as much as now people are becoming aware, sort of what, we've been talking these, 10, 15 years, and we do them when appropriate. But there's, I think, sometimes a better way to do this, especially like I said, when I was dealing with somebody who had a pension, taking a pension reduction in order to be able to get the spousal benefits. Sometimes that's where life insurance can come in as an asset class. And really, it's a unique strategy. And she said it, she goes, huh, that's a pretty interesting concept. And what I was saying was basically, look, if you have an account where we have all these taxes that have just amassed that are still not paid yet, right? Eventually, we're going to get to RMBs. We got to pay this. Let's just take out, maybe it's $20,000 a year, and I was just doing a 10 pay. So $200,000, and buy a second to die or survivorship policy. And what that effectively does is it replenishes the estate because it's not subject to income tax. And basically, it's a permission slip for the clients to spend all their money. And really, it was like an aha moment today. And that's where dealing with somebody, a seasoned advisor like ourselves, we really have a lot of creativity when working with households. But back to the point today, which is direct indexing. So, first of all, what is direct indexing? Direct indexing is when a target market, and again, our target index like the S&P, is replicated by buying individual stocks in the same weight as the index. Instead of buying all 500 stocks, again, in this example, the S&P 500, the index is going to replicate by buying only a portion of those stocks in the same weight or sector or weight. So, instead of if there's 500, depending on somebody's capital gains budget, and I'll get to that in a minute, maybe they're buying 100 stocks or 200 stocks or 300 stocks. They don't need maybe 200 or want 200 for a multitude of reasons. And our whole trading team, I think we're one of the only firms around that actually utilizes this strategy. It's really cool. And then when you incorporate that to tax loss harvesting, wow, now you have a really cool strategy for non-qualified money. And that means money that is in a brokerage account or whatever. We can still diversify and have individual stocks in an IRA or 401k or a TSP or something to that effect. But this works best, especially for the tax loss harvesting when we're doing it in a non-qualified. But direct indexing, it can be made to replicate almost any portfolio. So there's just different ones, and if you have, say, your the Catholic value, so maybe there's some stocks that you absolutely don't want to have held in your specific direct indexing bucket or basket. You can start to carve that out, and that's again another way to be efficient. It's when SpaceX went off last week, there was people calling up saying, hey, they wanted to try and get in for the IPO. So, there's times when people will call and say, hey, I love this company or I dislike this company. Can we carve that out? And using this strategy that allows us to do so. So Simplicity Wealth handles all the trading functions to help investors save time, optimize their return. So, on the right side is really just the multiverse, and you can see the Mag 7 up there, the big chunks of an index. And then you have all these other smaller slivers of stocks. And quite often, a lot of those stocks are in sectors, and that's where, again, we'll talk about tax loss harvesting later. But to the left is really just in this example, 10 stocks from different sectors to build out a custom portfolio for the client. And that's again all done by our trading team, an investment planning team. So it's really been a well-received and proven strategy for our clients. So, basically direct indexing terms and trade-offs. So the first thing we have to understand, the actual performance differs between the investment in the investor's account and the corresponding benchmark. Capital gains budget, I mentioned that earlier, but that is the amount of realized gain, long and short, that the investor is willing to take. It's not just the amount of taxes they will pay, since the tax rates will vary amongst households, right? But generally, the more capital gains the investor is willing to take, the lower the tracking error. And you'll see that on the next slide. Assuming that the account is coming over with in-kind securities, stocks and mutual funds. So let's say you're on this call and you say, hey, Chris, you really caught my attention. I have a bunch of stocks. I like dividends. I want all this stuff, but I'm over here and nobody's ever mentioned any of this stuff to me. Well, then we would bring that over in kind. We wouldn't typically empty out the account because you might get hit with a large tax bill. But then once we look at it, we might go in and identify losers within that account, and we'll suggest, hey, listen, we could literally go ahead and sell out of those positions, simultaneously buy a similar type holding within the multiverse of stocks, replace that, get the capital loss to offset some of the yield that we're getting on some of the winners. So it really is a very cool strategy. Now, what I'm going to do here, there's 4 scenarios in this. So let's just say, and the point of this is the initial VAR score I'm going to talk about, and on the next slide, I'll revisit what VAR actually is. But it's a methodology that we buy into. But if somebody's capital gains budget was very small, and they said, listen, I don't want to have a lot of tax bite next year. Well, we might only budget $10,000. Even though their score, their risk assessment that they took is 50, it still might leave them up and around 95. And what we're trying to do is ultimately get them back to the 50. Actually, let me correct that. They came in with their existing portfolio at 95. We're trying to get them to 50, but the tracking error is 8. And you'll see that on the next slide, what that number means. But as we increase the capital gains budget, right, it's $20,000. Now our tracking error went down by, say, 6 bips. or 6 points. And from there, this person's portfolio might also, because if they had that kind of capital gains budget, it actually reduced their overall risk on their existing portfolio. Again, the target based on our analysis and assessment based on how they answered the questions is still 50. As we increase, we go to 30. It's dropping their risk of their current portfolio, still trying to hit that target of 50. And then ultimately, if we can get within start to a high degree of tracking together, you can see even with their current portfolio. And again, you'll see on the next slide, I like to think about the red, the red, the orange, the orange. This is a speedometer, and our VAR score goes from 0 to 100. And most people, as we enter into retirement, are not comfortable doing 100 miles an hour down the highway. And so, if we're trying to get someplace and we're trying and we can do so safely and with less risk, that's what our assessment tool does. So once we identify that, in this case 50, you'll see that starts to how that starts to cross over into matching up. But before I show you the next slide, just again, Simplicity's proprietary algorithm is based on a value at risk methodology. Basically, it's 2 words, and I'll talk more about this in future segments, but it's magnitude, right? So, how much pain do you or are you willing to accept before you tap out? But as much as you might say, okay, that's on a scale of, 0 to 100 in this example, and you go, hey, listen, I can handle 100% of pain. All right, it's your money, right? When we're younger, sometimes people can do that. But as we get older, right, we tend to say, yeah, that hurts and it hurts for a long time. Well, now as important as that is, it's how quickly does that happen? And we'll talk more about that. So the 2 words I want you to think about are magnitude, so the degree of the pain, and then quickly, how quickly is that pain being experienced? It's really, really critical. And that number that is we evaluate and assess, then we match up with an investment strategy that fits your household. And one of the strategies that help us to do that, to make sure that we're staying aligned with you, is the direct indexing. So if we look at a tracking error performance variance, right? So if 10% was the index return, and we'll stay with the S&P, right? What this saying is if you had a tracking error, it means that we could be above that. We could perform better and 15% return, that's great. But what goes up means if you could do 5% better than the index, you could also do 5% worse. But as we start to, and this is why if you have the ability to increase the capital gains budget, we're trying to narrow that range. So then even the same 10%, reducing that tracking error for between 6 and 14, 7 and 13, eventually now 8 to 12. Now we're right in range of 1 point of a higher low. And that's, so we didn't have the full index. So maybe not all 500 stocks. Maybe we had 200, 250, 300, 350, and we're able to track really closely. So that is ultimately what the tracking error is discussing. And then it just says, look, if this is what the index is doing, the blue line, sometimes we're going to be below what the index did, but other times we'll be above, right? So this is why just assessing risk, using our risk tolerance questionnaire, understanding the household, the goals of the clients and the family that we're working with, we can make recommendations that will help you to achieve your goal. So, folks, that was a fast-paced sort of exposure to direct indexing. Next week, we are going to talk about tax loss harvesting. That will sort of just mirror off of that. And then I'll circle back to some of the other communication tools and just making sure that, that things that you're currently doing, if you'd like us to review your portfolio, if you're already with us and have onboarded, we've implemented strategies with you. And for the most part, everything that I'm seeing when we're monitoring clients and reviewing seem to be tracking pretty well. But if you've not engaged with us yet, maybe you've been meaning to, you've been on the call for a while, maybe you've been thinking about it, but you've been busy. I get it. We would welcome the opportunity. Let us give you a second opinion. We're happy to do so. So, folks, I want to wish everybody a wonderful weekend. The World Cup tonight, 10 o'clock. USA, USA, USA. Let's go. I'm so proud that I really feel that America is back. I see that, as I was traveling through the airports, American Airlines was on. They were talking about soccer. There were soccer fans in the airports. It's been pretty cool. So, let's get that message out there to our fellow community and neighbors and family members. It's okay to be proud of America. We do live in the greatest country in the world, and people are coming here and seeing it firsthand. And let us help you to retire and experience the retirement that you deserve and you've worked hard for. So again, guys, have a great day. Thanks for putting up with me, and reach out if you have any questions. Bye bye.